We now move on to the most awaited fireside chat of the summit, titled Tracing the Indian Microfinance Sector. The session will trace key milestones in the sector's journey, from early NGO-led initiatives to regulated NBFC MFs, while examining how policy, technology, and responsible finance have shaped its scale and impact. The anchor for this session is Ms. Geeta Goyal, former Managing Director, Michael and Susan Dell Foundation, MSDF India. May I request her to please join us on stage. Our esteemed speaker for this session is Mr. Nachiket Moore, visiting scientist, Banyan Academy of Leadership in Mental Health. Let's welcome them with a round of applause, please. A very good afternoon and a very warm welcome to both of you. I now hand over the charge of the session to the anchor. It's over to you, ma'am.
Thank you. Good afternoon, everyone. I see, this was just announced as the most awaited session. Nachiket, thanks to you. I also feel we have a tough task of compressing 20 years of microfinance in 20 minutes. So let's try and see whether we can manage that. But yes, I think Nachiket needs no introduction, so we will not go to where he started, where he is. But we will dive straight into, I guess, what was it, somewhere in the late 90s when you got exposed to microfinance. And I think, I mean, at least from the days I remember, I would say when Nachiket engaged with microfinance, it was almost a concept, a fledgling of non-profit institutions delivering microfinance till, I think several pivotal moments over the course of the journey. And today it's pretty much a mainstream sector. So I guess I was trying to think how to make it short and crisp. Let me try. I think tracing it from the early days when you got exposed to it, I mean, clearly you saw the impact of it on the field. And also, given your research background, you would have also seen, the impact of it for the family, the community, the economy. But I think if we anchor it around the impact, any field stories that you would like to share, which sort of told you that this is the direction you want to take and, solve it for the larger nation. And of course, in between, you want to throw in your spurts of research, that would be great, yes.
No, thank you. It's a pleasure to be back here again for a second round of discussions from Vedinath in the morning into Geeta now. I must be honest with you. My background is in derivatives. I am actually not even a proper banker. I am a derivatives trader, and my PhD is in, stochastic calculus and all of that stuff. So my introduction to microfinance and access to the poor, originally, of course, I started my career with Pradhan. And I got the sense that health, education, financial services were important as capabilities, but that was kind of an abstract sense. I had never actually worked in this area. If you ask people at that point, what was I the person to go to for bond market discussions, not for microfinance. I really had a terrific team, though, that was deeply passionate about this. I had the benefit of Vijay Mahajan as a mentor from the good old days. And I came with the belief that if I had access to something, everybody must have access to it. It was not, I didn't have a clear sense that it will produce an impact. I was actually not even that worried. People say, what about consumption finance? What about this? I viewed these as basic essential services that everybody needed to have. And I must say, I was a little surprised that we were even talking about should they not, etc. So that was kind of my, first introduction.
And within the financial inclusion space, did you have like a preference for, say, let's start with credit or let's start with savings or insurance, both from, I guess, the the opportunity of, delivering it and or the impact? Or
I mean, the thought, again, as I said, informed by, there are many of them here. I don't know if Puneet is here, Bindu, all of these people were, the guides that I had helping me think about this. The idea was, why not all of the services that we can get? We didn't have a particular, and I must say, what was surprising to me, and I'm so pleased that as I've been listening to the conversations just now, there's so much progress that has happened. But I remember a meeting in the Leela in Bombay, where we had all the MFIs equivalent come in. Total portfolio was 200 crores of the entire sector put together. And I was a wholesale banker. I was not a retail banker. So, it was a bit surprising to me. But my team felt, no, sir, you must come, you must spend time, look at it. Because in ICICI, we were doing 5,000 crore, 15,000 crore loans. And really, it was an eye-opener for me as to what we can do. Because I found that these people on the ground, and that was Vijay, that was, various people there, they knew what to do. They had exactly the idea of how to deliver these services. They just didn't have access to capital. They didn't have access to debt. I said, these two things I have. I don't know what to do though. We bought Bank of Madura, I know at that time. And Kamath Saab in his wisdom decided to hand over the rural branches to me. I did not know what to do about rural branches. But coming from a strong finance, project finance background, I did the calculations and I realized that at our cost structure, we can't make it work. I went back to Dr. Tyagarajan and I told him, sir, aisa karte hain, why don't you take it back? The microfinance portfolio. It, started the Madura Micro there. And that, I would say, was the journey of lending. Then came this whole business correspondence. Because one of the smaller banks had reached out to me, Cooperative Bank, to say, can we get access to your ATMs? And it turned out that it didn't work out like that. Because there was a sense that, larger banks had that posh ATMs, poor women, is not a... But then Puneet discovered, Mr. Lula's business correspondent, went to Brazil, took a look, saw what was going on, and long story short, we started that process so that they could, get access to that savings side. Insurance, we worked with Lombard to try and see what we could do. I would say that journey was not quite as successful as I would have liked to make happen. Also, what I was telling you earlier, risk management, these derivatives and all this stuff. We started NCDEX, made some progress, but it got stuck at futures market. It got stuck at large contract sizes. If you're a small farmer with 2 bags of wheat, I couldn't find a way to get you to trade it in the market.
No, excellent. And I think if people in the room don't know it, many years ago, what we call BC model of lending today was the partnership model that actually started at ICICI. And I'll come back to it. But I think between, say, 2000 to 2010, microfinance sort of projected, the perfect combination of Samaj Sarkar Bazaar, as we call it. I mean, we had good benefits from the government, whether it was priority sector lending, the SHG movement. We had philanthropic capital, both in India as well as in other parts of Asia, which had proved out the model. And there was market capital and, bank support, etc. So I think the journey was going pretty good. And then we hit the 2010 crisis. And I'm sure that was a moment of pause and reflection for many people. So just your thoughts on what, I mean, given the 3 players were coming in together, obviously there were some gaps and things fell through the cracks. What led to it? And maybe then you can also move on to, was it a failure of the system or was it just a course correction that 2010 offered to us? And
my own sense as somebody who was quite involved in the sector at that point, I think it was more, I remember one conversation with a senior, I won't name names, but a senior banker, MD of a large institution. I ran into the person in finance ministry. And the person told me, Nachiket, I understand you're making money in microfinance. Initially, I thought the person was praising me. So I had a big smile and I said, yes. Then I realized this person was very upset with me. as to what is going on. How dare you do this? I think it took some time to form a culture that goes in to say, I will accept 50% default rates in farming. I will go ahead and build a kind of a slightly on the side little activity, largely run through CSR, to a mainstream commercial activity, which meant if you took the money, you got to give it back, you know. And I think both sides, one side was horrified that this was a financing mainstream transaction, but I think the other side also didn't fully understand. You know, sometimes as they say in Hindi, Naya Mullah 5 baar namaz padta hai. You know, they became too tight. It was a process of maturation, though I must say, I'm personally not entirely convinced that the corrective measures we took were indeed corrective, or were they simply a mechanism to try and reach some understanding so that we can move forward. Because I find still today we have awkward discussions about consumption finance, asset finance, durable finance, productive finance. It's not a question you and I are being asked. You know, why is it that the poor women are being asked?
And I mean, yeah, I think what emerged after, whether you know it was just a stopgap, or did it set out the story for the next 20 years? But I think one of the things that did emerge from there was also our move towards small payment banks, small finance banks, and again, I think taking the definition of financial inclusion to its truest sense. And you were very involved in the regulations for the small finance bank. So again, I'm calling it an experiment. Has the experiment played out as expected? Could we have done better? Are there things in the design which, could have led to stronger? I mean, I do feel a lot of small finance banks are now applying for universal banks. So do they move away from where they started? And do we need to hold them to where they started for their entire life, or is it just a transition phase? So,
I think we will know over time. The one issue, though, it became clear that if you are a non-bank finance company, you don't really have friends. It's easy for people to pass regulations that brush you on the side. If you're a bank, it's not quite so easy to do that. And in some ways, getting some critical members on the other side of the fold, whereas they become our entities rather than those entities, was quite an important step. Because now you couldn't simply brush them aside. They were big players and they were part of your fold in some ways. But in all honesty, did we really need savings institution to be taking on high-risk debt? I'm not entirely convinced from a systemic perspective that was the best. In fact, the Narasimhan Committee original idea of keeping the NBFCs as the front line of high-risk lending and allowing them to fail as needed would have been the right idea, but unfortunately, regulation didn't quite see it that way. They saw them as competitors. They saw them as people who were entering spaces that did not belong to them. So maybe this was a mechanism to kind of build the transition. But I must say, I have been somewhat anxious about savings-led institutions, going out there. We have seen the experiments with cooperatives, with RRBs. So I'm not unhappy that there is this transition going on. I think the example of Vaidya, for example, that you saw, that he spoke about in the morning, and if you start somewhere, a large part of you remains there, no matter what you do. It doesn't go away just because you've changed your legal structure. And I think that will be something that will endure, even as they become bigger small finance banks and then go on to become large banks.
yeah, I mean, I think you made an interesting point about savings-led institutions getting into high-risk funding. And I mean, I think the point here is these are not just savings-led, but the small finance banks are also higher cost savings institutions. So, in some ways, we've added the cost, the pressure of a bank, the systems of a bank, and they continue to do the high-risk lending. So, did we put more pressure on them versus, they could have just acted as NBFCs? And I want to go back to your, thought of, I mean, the starting of the partnership model, the current BC model, the recent digital lending guidelines, and I think again, uh, let me say, not an aversion to risk, but a control on risk. I mean, a lot of this, the recent digital guidelines is saying, who's taking the risk and how can that risk be monitored, and are those organizations capable of taking the risk. Uh, any thoughts on how we continue to allow for some risk transfer, because that's what is needed, uh, and yet have frontline teams, frontline organizations continuing to experiment with higher risk lending?
No, see, my general view has been that you don't want to build safe NBFCs and risky banks. Right? What you want is the opposite. You want entities at the front lines that are taking risk. I have personally never seen the value of capital regulation or prudential regulation for a systemically unimportant NBFC. Until you cross 50,000 crores, I should treat you like I treat Reliance Industries. They also borrow money from banks. They're a corporate. And the lender decides what is the appropriate leverage ratio, etc., rather than saying, there must be minimum here, minimum there, etc. I'm sure this has gone through much debate and much discussion. I'm not saying this is one of those casual things. But my personal view has remained for a while, that the core Narasimhan Committee vision of layers of institutions at the front line, and I said this in the morning, we are far away from our target. There is a sense of achievement which is terrific. But we have 30% credit to GDP ratio in Bihar. We need 10 times more. And Bihar is not going to grow. We may say whatever we want. We need to get to $13,000 per capita by 2047, which is the developed country number. This is not going to happen. And certainly not going to happen universally. It may happen on average. Yeah. But there was a nice data set somebody presented when they looked at per capita GDP of district-wise Bihar. Patna is 1,30,000. There are districts in Bihar that are 20,000. If you're going to get them there, we need the credit penetration to go. I would not be happy if banks were being told to do this, because it is high risk. You need to figure this out. Right? And institutions will fail, and you want them to fail, because otherwise they're not experimenting enough. You've been an investor. If you have no failures, it means you have not taken enough risk. And I think it's a deeper conversation we need to have as to what are we doing about growth of the country. Not simply about access to finance, which is seen as one welfare measure on the side. I don't think that is the case.
And linked to access to finance, so one side is credit, and will credit alone without linking it to livelihoods, can it play an important role? And then, the other aspects of finance, do you feel we've done enough on the savings and the quality of savings and insurance and investments? I think on that stack of credit, savings, insurance, investments, where do we rate ourselves today?
One of those kind of, open secrets of India, as you know, is a difference between the risk-free rate at which the government borrows and the savings account rate of banks is 400 basis points. Worldwide, that number is 4 basis points. Right? 70%, or between 50 to 70% of bank profits come from this arbitrage. This money belongs to poor people. Why are you not raising interest rates in your policy-oriented public sector banks to T minus 2 basis points? Why are you paying 2.5%? Why are you paying 4%? So, in a way, the poor are putting savings with you, but you're not giving them much of a return. You're not even tracking inflation. And you could have said, why don't we go to money market mutual funds? But those channels are not for the poor. The requirement of KYC, the requirement of, the cost associated with it are just enormous. Because that's what happened in the US. If banks were not paying money, the channel to money market mutual fund was opened. 40% of bank deposits went to money market mutual funds. It forced banks to raise interest rates. Unfortunately, in India, that is still not happening. Large banks are sitting on CASA numbers of 50%. CASA is what? 400, 500 basis points below the market deposits. So clearly, we have not done enough, even for people who have created the savings accounts. Right? And, insurance, my pet peeve on derivatives. Why is it in Australia, I can go to Commonwealth Bank of Australia's website as a farmer and I want a put option on my wheat crop, I can buy it. In India, I just don't have access to that market. I don't see the reason why.
And a lot of these, I guess, are very important pillars for the Viksit Bharat, right? I mean, they almost
Absolutely.
essential.
Absolutely essential.
Yes.
What are the poor doing with their savings? They're buying more land, more low-yielding cattle. You know, why would they do that? If you made it possible for them to diversify, to manage their risks much better, it would help the banks as well. Right? Because what are the poor doing instead? They're using another option that they have, which is default. But that's not an option that builds good financial discipline or good for financial sector. Which is why we are stuck with group lending as the principal force, because while group lending is good, but if you think about it, what are we telling women? We are telling women coercively that if you don't show up in a group, I will not lend you money. I will deny you access. Wouldn't I want to tell women that no, I would be quite happy to lend you? But that's not what we are saying to them.
Talking about group lending, I mean, I think I used to keep hearing that microfinance or group microfinance goes through cycles. Earlier I think it was every 5 years, 8 years, we see a dip. But I think at least in the last 8 years, we've seen 3 big crises emerging, whether from demonetization, then COVID, and then the recent overlending. I mean, while the first 2 had reasons for it, the third didn't. And is there, again, I mean, your view on how do we prevent at least not the forced crisis to happen?
See, my sense though is that no markets work perfectly. Bubbles build. And it's like internet. You saw market prices go crazy, stock market prices go crazy. I had an opportunity to spend almost 2 hours interviewing, like we are having a chat. I had a chat with Alan Greenspan for another audience like this, right? And this was after the US crisis. We concluded, and there was, Alan Greenspan said, I tried to raise interest rates. What I found is that the size of the bubble went up. Right? I just could not control the crisis. He said later on that, incorrectly, that let the bubble burst, we'll pick up the pieces quickly. Right? And I would say rather than preventing bubbles, much better to think about resilience, and which is where I worry about deposit-taking institutions entering these spaces.
True. Right.
Because you can't let them fail. The systemic shock of a large deposit-taking institution failing is enormous. And you might say we have deposit insurance. Deposit insurance, original deposit insurance was to prevent customers from thinking that their deposits are at risk, not for actually insuring anything. That's why they are so small. A large bank fails, there is not enough money in deposit insurance.
And I think, I mean, once we fail the customer, the trust in the whole system reduces. So I know we are on time, and I think there might be lots of questions from the audience, but we will not take questions. We will end, but maybe just 2 minutes, Nachiket. I mean, I think the pivotal moments in the 20 years I see are, the SHG movement, the birth of MFIs, and the NBFCs associated with it, the 2010 crisis, SFBs, and but if you look back, I mean, one, if there's any other pivotal moment you think of, and 2 is one thing that you would have done differently. I mean, you as I'm just saying as a sector, like just as a participant in the sector, which would have just made us stronger today, besides the regulation part that we talked about.
Yeah. I mean, I wish I had spent more time fighting the risk management battle. I think we gave up too quickly in ensuring that farmers, individuals had access. Because, when I left my job at Pradhan in 1986, 1987, I'm an old man, I had the sense that the poor know how to live their lives. We don't need to tell them, you become a plumber, you don't buy a TV, you buy a credit card. They know. What we need to do is to solve problems that they can't solve on their own. Systemic risks that they are exposed to. And of course that means education, that means health, but in the finance world. Bindu and I had written a paper in which we said finance should be thought of as a noise cancelling headphone. is there an opportunity for you to do things in a way that removes systemic risk from them? And today I would say that market, if I look at rainfall, if I look at commodity price risk, if I look at cotton, wheat, if I look at soybean, we just don't have the instruments in the hands of the people who need them. And I feel that's a tragedy, because what we are doing now is we're using debt to solve a problem which actually is coming from some other market. And as we know from our Arrow Debrew complete markets thinking, these are not substitutable securities. You cannot substitute savings and loans for state contingent securities. And so, that's a gap, I would say, needs more attention and more debate. But I must say in closing, I'm leaving actually quite enthusiastic after, Vipin got me to come here, but having heard everybody, I feel there is a lot going on that is really quite remarkable. And there are people here that are thinking deeply about these issues. There was a beautiful panel earlier about gender. I must say I learned a lot, and I'm feeling, the sense that while not everything is figured out, over time.
At least we are on the journey.
Indeed.
We are on the journey and we are moving forward.
Indeed.
Perfect. No, thank you very much, Nachiket. Pleasure to speak to you. Thank you.
Thank you to our esteemed speaker for sharing his experiences and insights. And a special word of thanks to the anchor, Ms. Geeta Goyal. Thank you, ma'am.